In this video, we're going to talk about the difference between your balance on your reporting date versus the balance on your actual due date. My name is Ryan Alexander from I Teach Credit. As you know, this is my card. This is my dream. The fastest way to get to this card is by educating you on credit. So let's talk about the difference. People ask all the time, does it matter if I have a balance on my reporting date or on my due date? And the answer is yes. The balance on your reporting date is going to impact your credit score. The balance on your due date, depending on how much of that balance you pay, is going to impact how much interest you pay. If you pay the full amount that is owed that month, you will not pay interest. So for example, if in the month you spend $1,000 and you pay $1,000 by the due date, you will not pay any interest. If you pay $995, you're going to pay interest on $1,000. However, on the actual reporting date or the end of the statement cycle date, it depends on what your credit limit is. Remember, that's utilization. So if you have a $1,000 credit limit and you have a $900 balance, that means your utilization is at 90%. Your score is going to get walloped. You need that utilization to be between 1% and 3%, which is why I say 2 days before the actual reporting date, pay your credit cards down to zero. Now, if you only have one credit card or two credit cards, I highly recommend showing or reporting a 1 to 3% utilization factor. So on $1,000, 10% would be $100. You want to show anywhere between $10 to $30. That would be ideal. If you have multiple credit cards, I always recommend having at least 50% of them showing zero balance and 50% or less having a 1 to 3 utilization factor on the reporting day. But when it comes to the payment due date, I don't care what anybody tells you. On that payment due date, you should pay whatever the statement cycle balance is to zero, okay? That way it ensures that you never pay interest. If you pay 2 days before the reporting date or the end of the cycle date, you're going to have a real tiny balance anyway, so it may only be $10. So if you pay your cards every 2 weeks, like I say, what happens is you're having a reporting date balance of $10 or whatever, your actual balance may be $500 2 weeks later, pay the whole $500 or pay $495 and reflect a little balance so that you do show something, depending on if it's the end of the month or if it's the middle of the month. But the best thing you could do is know the difference between the payment due date and the reporting date, and making sure that you're paying 2 days before both of those, so that way your end of statement cycle balance is always low and that your actual due date balance is paid in full. Okay? Hopefully that was helpful. If you guys have any questions, put those comments below. If you liked it, give it a thumbs up. Please make sure to share it. Any and all support helps the channel, and that helps me to help more people just like you learn about credit. If you have any other questions or any other topics you want me to talk about, make sure to tell me, share that, or put it below, and I'll cover that next.